Hola, bueno, bienvenidos a un nuevo Startup Grind. Gracias por acercarse en este día tan gris que nos tocó hoy. Es un placer para nosotros ser parte de Startup Grind. No sé si conocen, pero Startup Grind es un evento que conecta emprendedores locales en 150 ciudades alrededor del mundo. En este mes de mayo tuvimos como objetivo todos los Startup Grinds de todas las ciudades tener como protagonista una mujer, porque siempre son hombres los que van a los como speakers a los Startup Grind. Entonces, digamos, el objetivo fue tener todos los, igual nosotros ya lo habíamos convocado, Gwyneth, pero justo coincidió en que todos los Startup Grind, la mayoría está teniendo como speakers una founder. Así que un poco es digamos, el espíritu. Nosotros tenemos la dirección del capítulo local de Startup Grind, y el espíritu es conectar emprendedores, que hagan negocios, que conozcan, que aprendan, y eso es también el espíritu de la red de NXT Labs, y por eso es que estamos casi desde hace 3 años organizando este evento. En esta edición vamos a tener siempre, la estructura del evento es un emprendedor que es entrevistado por otro emprendedor. En este caso tenemos a Gwyneth Ketterer, que va a ser entrevistada por Alejandro Estrada. No sé si conocen Gwyneth. Bueno, ya tenían el currículum que los enviamos en la invitación, pero es de Columbia University, una de las 5 mujeres de Wall Street, sabe muchísimo sobre inversiones y finanzas. Y por otro lado, Alejandro es uno de nuestros inversores, mentores, y emprendedores, está todas las patas de nuestra red. Y digamos, es cofundador de Money y de iBillionaire, que son 2 startups en las que esperamos el próximo IPO. Próximamente. Por lo menos el ETF de iBillionaire ya está corriendo en nada. Así que, bueno, es un honor para nosotros tener este lujo. Lo estamos retransmitiendo online para la gente. Así que síganos por Twitter y retuiteen para poder. La contraseña de Wi-Fi es bienvenidos, y la red es NXT Labs. Generalmente soporta 300 emprendedores, 300 dispositivos, nuestra red, así que no la rompo. Bueno, ahora sí, los ubico a ustedes.
Okay. Well, Gwyneth, welcome.
Thank you.
Good to have you.
Thank you.
It's an honor to have you. Okay, so you are one of the 5 women now.
I don't know if it's 5.
So,
5 women
tell us about that.
First of all, thank you. Marta, thank you for having me. It's a real pleasure. And I'm going to start by apologizing. It's very kind of you to let me speak in English, but my Spanish is so-so. I understand more than I speak. And when it comes to finance, it gets terrible very quickly. Mm-hmm. I think we're doing this the wrong way. I think I should interview you, because you've been a much more successful entrepreneur than I have. But thank you. I don't know if you know it, but I met Marta a few months ago, and I'm going to do a plug for women at the Women's International Day. And she and I met in Cordoba because we were speakers, because the governor of Cordoba sponsored an event for International Women's Day. And she was certainly one of the most interesting women I met that day. And I followed up, and we met. And she told me about NXTP Labs and the idea and what she and her partners were doing, and I loved it. So I asked her how I could help, and I guess that's half the reason I'm sitting here, and I'm very proud to say that I'm an investor, too. So I look forward, Marta, to making lots of money with you. But I spent my career assessing value and assessing investments and people, and this looks like a really good one to me, and we can talk about that. And the people are fabulous. So anyway, that's my startup plug.
Right.
And I hope your companies make a lot of money too.
Hopefully. We want to see you happy.
So, where do you start?
Well, I think basically what I find super interesting is that you had a very, very successful career in Wall Street as an investor and M&A, and you did all the Wall Street, let's say, career. After that, you retired, sort of retired. We see you're getting back into action now. And you moved to Argentina, so it's super interesting. We will also at some point want to understand why and why is it that like there must be something super smart. We were the first group of women getting into Wall Street. You might be the first group of women getting into Argentina.
Yeah, exactly.
And also it would be great to have an insight on how you see the investment world here in Argentina, the region, and of course the rest of the world. So if we can start about how was those early days as a woman, I think it's a very interesting angle in Wall Street, and how you became an investor, a very powerful investor in Wall Street.
Sure, I'm happy to. First of all, my partners think I'm in Argentina because somehow I pilfered money out of the United States and I'm a refugee here. If you ask my partners on Wall Street, that's what because they don't understand. They think they must have missed something all these years that I ended up here. Anyway, I started my career in Wall Street in the mid 80s. I'm a dinosaur. I'm 51, which is ancient by Wall Street terms, really. I went to the University of Pennsylvania, which is a very good school, and I got a dual degree in arts and science and an undergrad degree from Wharton, which is also a very good business school. And to tell you the truth, women didn't do anything, but all these guys at Wharton were doing this thing, going to Wall Street to become analysts, and I think that, what are they all doing? And I started to recruit for that too. And then there was this thing called M&A. I didn't even know what it meant, the acronym. And it was mergers and acquisitions. And so anyway, I landed a job at a firm, which all of these firms have been swallowed up. At Oppenheimer, I was an analyst, and I went to Wall Street, and I was the first person in their 12-man M&A LBO group. And I was telling you a bit earlier, back in the mid 80s, there was no differentiation between principal M&A and what I'll call commercial M&A. So when a company came in, you chatted with them about their strategic plans, about whether they were looking for an acquisition or if they wanted to divest something. And the first thing I had to do in my office was look at it and see whether it made sense to buy for us. I mean, talk about a conflict. So I would look at it and say, is this interesting? Should we look to buy it? And if not, we sold it. And that's the M&A LBO world back in the mid 80s. And it was so nascent. If it was something we liked, I put together presentations, we did our due diligence, we would go up to the meeting of the partners, and Steve Roberts and Nate Ganscher would sit at the table, and there may be 8 other guys, and he'd say, how much? And they'd need, maybe it was a $100 million acquisition, and they'd need $20 million of equity, and he'd go around the room, and each guy would raise his hand and say, okay, I'm $1 million, I'm 2, and that was it. That's how the deals were done. That was in the old days. So that's where I got my first exposure to leverage buyouts and what I call private equity. I then went back to business school. I went to Lehman Brothers, which I thought was a really smart firm. I wanted to work abroad, so I went and spent 4 years in London, which was terrific in the privatization wave. And I was telling Alejandro, I did the first privatization for the Republic of Turkey. Again, interesting things. These are all sort of quasi-private equity, because there's sort of governments invested, corporates invested, and family invested, which were sort of the dynamics early on of a lot of the investment business. And then I moved back to New York because in 1994 I did a study for Lehman, who had gone public. It had been spun out from American Express, and it had gotten out of illiquid activity because it was damaging to its credit rating, which it needed for the trading desks. And I did a study on whether the firm should get back into the private equity business. And it was amazing because that business was so captively lucrative for the firm. It made employees wealthy, it made institutional investors wealthy, and it was a captive stream of investment banking revenue. Long term. I mean, you have these portfolio companies were captive clients for 20 years. So it was a bonanza. And so we unequivocally said, yes, the firm should get back in it. I moved back to New York to help rebuild that business. And we had nothing. We didn't have anybody that knew how to do an investment. We didn't have anything at all, but we were Lehman Brothers. So you couldn't say, we don't know what we're doing. And we didn't know how to raise a fund. We didn't know how to invest a fund. And I had, bootstrap yourself and you do it. So we bootstrapped and raised a $2 billion fund, which was a lot then.
What kind of LPs you had back then?
Everybody from, well, we had the firm, obviously, and employees, and I'll tell you about why that's a good incentive. State pensions, CalPERS, CalSTRS, Louisiana, New York, government of Singapore, Temasek, banks at the time were very big investors, all of the banks, because they wanted a lending business. So all of the banks, in fact, that's some of the trouble that you're seeing today, which is all of the illiquid holdings they have. Much of that came from the early days of having to invest in private equity funds and hedge funds for their business, and that's what the banks had to do. So they were big insurance companies.
This fund that you started was going to do mostly equity acquisitions?
Only equity. It was $2 billion of blind pool illiquid equity. No investments, no anything.
And what proportion of companies would you take when you invested?
Control. Typically, none of these were control positions. I mean,
how do you do with management? When you make such an operation, you're not an expert maybe in.
Like become one. Trust me, you trust me. The one fascinating thing about this business is you get to learn all the time. I mean, you move from looking at healthcare to biotech to paper manufacturing to clothing.
So how's the typical process? I mean, as entrepreneurs, it's very intuitive how if you decide to come buy a $100 million company or $200 million, and now yours, then you have to manage that. How?
Okay, let's take some examples. So I'll give you a bunch of different ones. So there's the entrepreneur that's sitting in LA in his garage, right? Buying fabric from Japan, cutting holes in denim jeans to make women's butts look good. And they're called 7 jeans, 7 for all mankind. The guy's getting stoned half the day and he's selling these things out and he doesn't know what to do. And he's charging a couple $100 for a pair of jeans. I mean, and the margins are extraordinary. But he's paying a fortune for fabric. He's practically making them in some warehouse in LA. And he's distributing them, but he doesn't know anything about marketing or distribution or how to lower costs or internationalize his business. So in comes us, and we sit down and we say, look, we want to be your partner. We want to take you to the next level of everything. Okay. So we sit down, we buy half of his company, we give him a contract to be in charge, incentivize him, he cashes out some in some tax efficient way. Okay. We put some debt on the company, and then we open it up and we blow it out. So we get cheaper clothing. We open up a factory in Mexico. We do all kinds of things. Figure out how to put Swarovski crystals on them and charge $1,000 for the jeans in Milan. Okay. All that kind of stuff. And we also think about a strategy. If it doesn't work, what are we going to do? Because this is high risk for us. This is a high risk investment. Who knows if 7 jeans is some hot thing or not? Yes. So then we figure out, okay, fine. If the shit hits the fan, we can sell these jeans through Walmart for $70 a pair. And get out. So we incentivize the manager. Well, what do we have to do? We had to hire a CFO. We had to teach a CFO. We hired a COO. We had to find a manufacturing plant. We truly had to institutionalize this guy.
So back in that days.
That's not even that days. We're talking. I don't know.
What is the difference
2002.
What's the difference between what a regular VC or more aggressive VC would do today from the private equity work you did compared to a VC?
There's all the stages of man, if you will. There's what Marta and her team do, which is the angel investing, which is taking an idea without anything and helping folks put something around it. And then there's the VC who looks at the business plan and decides whether he can put an advisory board and he can be a partner or a mentor to a CEO or a team of guys that have a good idea that's baked already. Somehow the model's been proven a little bit, even though they don't have any money. Then there's the guy that's actually done something that needs to sort of take it from just being the garage entrepreneurial business into something for real. Exactly. That's that sort of JV tactic. That was one of the things that we did. And then there's the pure LBO guys that buy the conglomerate, the Blackstones, the KKR, that buy the $10 billion Hiltons or whatever they do, and that's a different game too.
So your typical transaction was which
size? Companies $100 million to $1 billion of firm value. Wow. We wrote checks. I don't know. We've written little checks, 10 million. I mean, we've written them as small as 10 or 20 to 250 million. Okay. And then all that gets leveraged. Wow. So that's one example. We talk about the entrepreneur that needs to blow it out. Then there's the guy like a Stuart Weitzman. Right? Stuart Weitzman shoes. I don't know if any of the women in the room have heard. I'm wearing them Anyway, he represents 10% of the women's shoe department in Nordstrom's, Saks, Macy's, Bloomingdale's. I mean, he's really done very well. And he is taking out of this business $50 million of cash a year, and he owns it. And he goes to Spain 6 months a year and makes shoes, right? That's what he does in some little apartment, 1-bedroom apartment in the middle of nowhere, and he makes shoes. And then he comes back and he sells them, and this is his wonderful business, and it just stagnates, and he's got this wonderful name. And it's mature, and it's throwing off cash flow. So what do you do to Stuart? You teach him how to open, instead of using Saks and Macy's and Bloomingdale's, how to open up retail stores. And not just in the US, internationally. And you say, listen, Stuart, great with the premium line, that's terrific for the $300 shoes. Why don't we have a line that's made in China that are, $75 or $100 shoes? And so you teach him to blow out his brand. And so we partnered with him. Now that's a mature guy, but the same JV kind of mentality. And then there's the last one, which is, there's the take privates and all of that in the public markets, but one of the things, the backbones of the buyout business was corporate orphans. That's like the gems of our business, which is you take some conglomerate that has, 20 little fingers and things, and, that's got some big names and then some little things that it doesn't know what to do with, but it doesn't want to admit failure, so it quietly wants it to sort of lead the portfolio, and they'd rather negotiate with someone privately than have a full-blown M&A process. So for example, 1998, the Limited, I'm talking to the Limited, and the Limited has this dog do business called Chelsea Campbell, and it wants to sell it. Limited's known for things like Victoria's Secret. So what do you care about? Some doggy, old age, women's business that makes nothing in B-class malls, or Victoria's Secret with the sexy lingerie, which is on billboards everywhere, and a big cash machine. That's what the Limited should focus on, right? And all its other big retail, not these crappy little pieces that they thought they made mistakes. So we go and we evaluate it, and we think, maybe we can do something with this. Our investment thesis is completely wrong. We buy this thing for $16 million. We put $6 million of equity in it. We had the Limited take back a note for 10, so we didn't even have to finance it. And we get this thing, and we look at this Chelsea Campbell and the mall locations, and they're all terrible. And we look at the clothing, and it's awful, and the model is awful, and the plan is awful. We're thinking, oh my God. But luckily, we didn't pay much for it. So we didn't pay much for it and had real cash flow. And then we look, and we see that there's this nascent idea. There's this other brand that's owned in Chelsea Campbell, which the Limited started and did nothing with. And it was called Aeropostale. And we look at it, and it's sort of this hip thing. I don't know if you know, but every drug dealer in the world walks around with an Aeropostale t-shirt, not to mention every teenager. Yeah. So we say, oh my God, there's this gem. So we shut down all the Chelsea Campbell stores, and we put in Aeropostale, and we hire a management team in to do this. And we took this nothing thing to $1 billion company and turned $6 million into $486 million of value, our equity. That was one of the best.
How long did that take, the process?
We took it public 4 years.
4 years.
Yeah, and then we slowly sold out because we held on to it because it was growing. But I couldn't believe it. I remember like being near Harlem or up at Columbia and seeing these guys with a t-shirt. I was like, oh my God, how did this happen? A bunch of white guys sitting in Wall Street, and now, how did we do this?
So when you talk about this, you put a lot of passion. It seems like this is in your blood. I mean,
I don't know.
So
And we made mistakes too, trust me.
Sure. But I mean, how did this came to an end? And what was your decision, your personal decision? And
look, the rah-rah days aren't the same anymore. It's much more mature industry. And if you ask me, we moved beyond the just buy the company because it has cash on its books and use its own cash to finance, which is what the Wild West did in the early 80s, to the markets being good and taking things back public, to now you really have to do something. You really have to add operational value. And so the private equity firm is no longer a bunch of just financial engineers. That's one small part of it. You've got to have experts assessing it, knowing in advance what kind of changes and what kind of synergies and savings they could bring, to having a stable of management that could come in and execute it. It's a much more sophisticated business now. But for me, it was 2009 2007, and I had just raised a $3 billion fund for Bear, because I went there to start a merchant banking business, and we were raising our second fund. We were looking very successful. We had a 60-man team in place with operating partners and all kinds of bells and whistles, and I thought, okay, it's a very good time. World is good. Markets are good. I've done well. I had very small children then, and I thought, time to make a change. What do I need? Maybe it's time to move on. And so I went to John, the partner that I started with this business, and I said, this is what I'm thinking, and he thought I was out of my mind. And we started talking about it, and I said I'd transition and all of this stuff. Remember, I said this is at the end of 2007. Right? And so we talk, he goes off, he's not believing me. Now it's February, now it's the beginning of March. We finally agree a term sheet, and I said I'd stay for our shareholder meeting in June and transition everything. And then something happened. It's March of 2008, and something's wrong. And I was on this president's board of Bear Stearns, and I went out to lunch, and Alan Schwartz flies up from Florida, and there's Minnicus, the treasurer, and everybody, we're sitting in this room, and everyone's starting to panic. The hedge funds are leaving the firm, and where's Bear's credit? And Alan Schwartz is telling everyone to go back to their desks, that this is some blip in the market, and everyone's misbehaving, and it's going to settle down in a couple of days, and the share prices are starting to go down, and everyone's starting to worry about the firm's trading credit and other firms, and the world's not making sense anymore, and everybody's calling margin, and they're pulling capital, and no one has the money because the books aren't balanced, right? We're having longer term debt, and everyone's pulling the money, and there's no liquidity, none. There's no liquidity in the market, so people panic. So I sat in his office that Friday and watched the stock of Bear go down to the floor. He looked at me, and I said, look, we'll just wait a couple of weeks to announce my leaving, because everything will have to settle down. And the next thing I knew, that next morning, Alan Schwartz calls me, and I go to the firm at 8 a.m. on a Saturday, which I've never done. And there he is, my partner, with a cup of coffee, and Bear's gone by Sunday evening.
Wow.
Yeah, it was wild. It was really wild. So much for my retirement at the time, and I agreed to stay and figure out plan to get us out of Bear Stearns. And so I worked against Jamie Dimon and his team, and we tried to come up with ideas that would be palatable to him, and basically spun ourselves out of JP Morgan. It became today what is Irving Place Capital, which is a $5 billion middle market private equity firm, and we're one of the few positives in all of this. But my resume looks pretty shitty, because I worked at places that no longer exist. Half my career at Lehman and half at Bear. The only thing I have going for me is Marta and NXTP Labs, thank God.
So, and how come you decided to move to Argentina?
I would say this is this ripe investment haven, and I looked at the world, and I put my dot down, and I did all. Are you kidding me?
No.
What did I do? I was a professor, so I left my job, and I had agreed with Columbia before the crash of Wall Street that I would design a course. So I did that for 3 years. I designed a course while I did in my awful year. I both taught in 2009 and got my firm spun out. But I designed a course in private equity for the business school at Columbia, which was also interesting and fun, which exists still today. And then I thought, what I want to do, and it really wasn't about investments or money. It was about my kids, and I wanted them out of New York City. I wanted them it was too material, too fast paced. There were a lot of negatives to having small kids in New York if you don't need to. And I wanted to take them somewhere, because if there's something I regret in my education and background, I'm not bilingual and I'm not bicultural, and I regret it.
Yeah, I have listened to you talking Spanish.
No, but no. My kids are porteños. And they're like little.
Okay.
No.
Okay.
And they were young enough, so I wanted to have an international experience, and fortunately, I had the luxury that we could do that. So, 3 years ago, we moved here. My kids went to school.
Had you been in Argentina before?
No, I mean, I did Google you. I Googled you because I didn't know exactly where you were. So no, I did. I did some reading. I did some reading, and but it made a lot of sense. Why? I'd never been here. I'd never done any business here, so it would be an adventure for everybody. Argentina has a wonderful wealth of natural natural resources, natural wonders. You know, there's deserts and there's mountains and there's wine country and there's whales and there's penguins and there's the Norse and the indigenous people and there's Patagonia. I mean, there's all kinds of wonderful things. They love family. You know, it's a very culture surrounded by family. They take good care of people. And it's a language none of us spoke. Climate seemed nice. Yeah, so I thought, why not? So my kids were young, and why not take advantage of those kinds of things? And so we moved in.
Just
yeah.
One day you moved to Argentina.
Yeah, I came for a week and then went back, and then I moved my kids. I looked at one school, and then I said, yeah, let's do it.
Fantastic. So you have been in Argentina for now?
I'm coming on. My kids have done 2.5 school years, so a little over 2.5 years.
Wow. So
I did nothing in the beginning. Trust me.
Okay.
I travel all the time.
Okay.
And now I'm starting to get back in touch with things and meeting. In fact, switching from knowing some expats to having terrific local friends. So the bulk of my friends are now Argentine. That's great. And I'm meeting more interesting people like you every day. So I met Marta, and this I thought was a wonderful opportunity to see why. Why is this a wonderful opportunity for me as an investor? A couple of things. One, they're at the forefront of what is still a very undeveloped market. I'm not just talking about Argentina, I'm really talking about Latin America. And you can talk about the growth of Brazil or Mexico, or we can talk about Colombia or some other thing, but trust me, relative to Europe or Asia even, next to Africa, which is below this, there isn't, you know, this is nascent. Why? The laws change all the time. There really aren't capital markets. There isn't a pan-American banking system. There isn't investment, you know, comes in and pulls out all the time. So it's a new frontier. So that's interesting. So you've got that going for you. You've got folks at the cutting edge of smart ideas, young, hardworking. So in terms of what I call the human component, which is extremely important, that's looking pretty good. I was telling you earlier, Marta and her team have already funded a bunch of investments. So for me, as an outsider, I'm not looking at just a blind pool. I get to see the model and see some of the companies they've met, what has been successful, what wasn't. More importantly, what wasn't successful, because that's good too. And how does the model work? So that's terrific. And then I was telling you, there's this, I don't know, fetish, hang up, something in this country and in Latin America about land and assets. You know, North Americans don't have it. You know, I think having a security is better than having an apartment sometimes, because I don't have to worry about it or pay the bills, and I can trade the security tomorrow. But people here think that owning Campo and land and their apartment is like paramount. I mean, that's your wealth. And that's what gets in trouble, because it's completely illiquid. And when things change, you can't monetize it. And it's very hard to explain that to anybody here. I don't know why. And then they believe they've got to give it to the next generation. I mean, they don't get leverage. They don't understand how to do that. And this model isn't anything about that. In fact, it isn't asset intensive, it's people intensive. And it's sort of cutting edge and internet, and it's transferable. You could have this business and move it to Colombia, you could have it in Uruguay, you could have it in my apartment. I mean, that's the beauty of it. And that's why I also think it's very interesting, because it almost transcends some of the crap, if you will, about the political system and the rules and all of that. It kind of exists kind of here, which is nice. So
and now you have been almost 3 years among us. And what is your vision, I mean, about Argentina, I would say, okay, the next 5 years, in terms of looking at from an investment perspective? I mean, it's opportunity. Would you recommend your colleagues on Wall Street to look at us or do something here or not? What should you do?
First of all, I think you have the luxury of being probably 10 years ahead, at least 5, of the big money that'll come in here if it does. And I'm assuming that the market's open, you know, that she's gone and there's a new system in here, and the market sort of, the gates are reopened again, and it's allowed to be a competitive country with other countries and international trade, and the subsidies go and all the other stuff. You have the advantage of being 5 years ahead of all that, because the big money can't walk in here, and it takes that much for the capital markets or banks to start lending against things and believe in cash flow and believe in asset values, and all of that has to sort of normalize. So insiders are going to have a tremendous advantage over what I'll call the Western money outside. and they'll move into countries that are a little bit more stable. So you have that jump start. I think it has to happen. I mean, I tell you, it's got to move forward and be on the Porteño side, or it's going to a very bad place because it's struggled for a long time not being competitive. I don't think if you just open the doors, every industry is going to be successful. I don't, because some of them aren't really truly competitive and they've been protected. You know, some of the technology, you know, all of the tech equipment, computers, TVs, all of that, white goods. I mean, it just isn't. Quality isn't as good as things made in other places. But there are industries, like they call the internet, or high tech, biotech, agriculture. I mean, there's certain pockets that I think are very good and can compete, or do already compete, unbeknownst to the government, in other markets. So, but I think you have to be careful about them.
Would you say that in areas where the government has not messed up, in Argentina does pretty well? I always have this.
Yeah, the other one, the other one I like is wine. No, I like wine anyway.
Yeah.
No, because I think that there's a really high quality product. I think it's kind of not part of the mainstay of what the government looks at. And so it really does have an import-export thing going on. I mean, maybe it gets whacked sometimes because of the value of the peso versus the dollar. I mean, there's some other nasties going on, but it actually has a very good product. And I think that the flaw in the system is that it isn't distributed well or marketed well. I think that's a real opportunity.
You're thinking about
the small
exports,
yes.
exports or from the internal market?
Yeah, no, in fact, not the internal market, because the Argentines won't pay.
Exactly.
They're cheap. They don't pay for quality, right? Unless it's foreign.
Exactly.
So, but the export, the foreign market will, and the quality of stuff is very good here. And I think there's a couple big guys. I mean, the Catenas, the Zapatas, you know, Cobo. I mean, there's a few Achaval. I mean, they know how to get out. And in fact, the ones that have done really well in the wine business, like Achaval, let's say Achaval, 90% of what he makes is for export. 10%, maybe 10% stays here. There's a reason for that. But I think it's not, all of the small bodegas that we all like, they're terrific. They don't have a good marketing strategy, and they don't know how to distribute themselves outside of Argentina. And I think there's a real opportunity for that. That's another business I think could be very competitive.
So
yeah, anyway.
Wine, services, internet.
Services, definitely. Marketing, distribution, branding. Think of all those things that, you know, the United States has been good at doing over the last 50 years.
Wow.
Yeah. And financial markets, like you.
Yeah.
What you're doing, the money wallet, iBillionaire, all of these things. Trust me, you need to bring in credit. You have to bring in a real banking system.
It has not been easy. I mean, you think why people really like land.
What is that?
Well, it's an asset that trades in hard currency, like US dollars.
Yeah.
It's very difficult now for government or anyone to take a piece of it. I mean, they do it indirectly, but it's a way of preserving value that the market has found with all these ups and downs of the economy. It's not easy.
But it's not. It's hard. It's completely liquid. I mean,
yeah, but okay, so I would say it has been a defensive move so far.
Yeah.
Well, you have seen the experience. If you want to buy land or an apartment in Argentina, you have to buy cash.
Yeah.
There's no financing for that in other markets. Okay, so maybe we open.
Yes, I'm sorry. I've been manipulating this. Please, I meant to say, ask questions whenever you want. Yes, sir.
Yeah. When you say that you invest in that company, how do you value the company? What do you buy? 51%? What is best for you to value high because you want to pay high?
How did we value it initially?
Yes.
In fact, my early background was in mergers and acquisitions, and if you ask me what skill do I have or what did I do in my life, I just valued things. I mean, that's what I did. I figured out what is something worth, and I could tell you what his watch is worth if I thought about it for 3 minutes. No, I mean, I look at everything and think about, and how do you do that? You assess it based on its size, its market. I mean, come on, these are all the fundamentals. Its market position, competitive position, how big is the industry, cash flow, EBITDA, multiples.
You don't take the potential. You say that they don't.
You don't want, no, look. I sit down and I do that, and let's say I figure out the value of this company is 100. I figure out it's 100 because it's got this of cash flow and its peers trade at these kind of multiples. And I say, okay, if I was public, it would be trading at sort of this. And then I think about what could we do to the company? You know, could we take out some excess cost? You know, what's the growth plan that we see that we could incentivize management to do? That I'm not paying for. That's the upside. I mean, so maybe it's 150 of value, but I'm only going to pay 100 because the other stuff is the work that we're going to do to it. Right?
You will 1%.
We typically you want control. So the private equity business, not venture, but the private equity business started with control because you wanted the ability to fire management, get out when you wanted to get out. So typically there were many firms that wouldn't look at anything less than control. We started to look at a new model, like I mentioned with Seven for All Mankind and Stuart Weitzman and others, where we said, we'll partner with an entrepreneur. We'll do something different. You know, maybe we each own 45% and we put 10% away for the management team. By the way, that's the special sauce in all of this is taking money aside, whether it's warrants, options, or getting people to invest their own money in the business, the management team. You know, all of this business, the whole special sauce works because of leverage and because you're incentivizing the management team to do something. So, but yes, we try to do control. But if there are special situations where we'll take less than control, like at 7 and Stewart, 40, but what we do is we take negative control. So we'll allow Stewart to maintain control, equity control of his company, but we'll make certain decisions where he can't act, but for our approval, or if certain things haven't happened, we can do something. If he hasn't performed, we can fire him. If we get to 5 years in and there hasn't been some sort of liquidity event or the capital structure hasn't changed, we can do something. We have control over the strategic plan or the business plan or whatever. He can't spend more than X million on acquisitions or on something without approval. So you put in negative control. Yeah.
I have a question regarding Latin America and your view of Latin America. Do you have as an investor, you talk a lot about your experience and your life and then Argentina, about why this is interesting. Wild empire, my words, but you said.
Yeah.
What about Latin as an investor? Do you see us as one region or you know different countries, or with you?
No, there's no question they're different countries. There's no question in different countries, and the money is going to flow into those that are the most stable and then proliferate out. And that's what you saw happening in Brazil,
Right.
you know, 5 years ago. Now people have tapered off because it's got a few hiccups going on. Not to mention the oil company, which is going to scare everybody. But there are. Come on, look at your neighbor. You know, Chile has got a much sounder. I mean, the problem with Chile is it's so small. So there aren't sort of big opportunities, but it's a much more stable economy and it's at a much more normalized growth rate and not the inflation stuff that's here.
Would you say that as an investor then you would really try to be more interested in Latin American companies has a full different places, or that would not that
Diversification? Yeah. And by the way, I think some of the companies that have done well here realized that a few years ago when there was a hiccup, when we had our hiccup in the world had its hiccup in 2008, I think that there were companies here that woke up and said, we need to diversify. So they started looking into Brazil or into Uruguay or into Chile or Paraguay, and they started diversifying. Ha! Marta's diversified. How many offices do you have, Marta? Colombia, Mexico, I mean, come on.
Colombia, Mexico.
See, she could move all of this to Colombia overnight. Isn't that great?
Right.
No, but I savvy investors aren't looking at Latin America as one place. It isn't. Not like the United States with different states.
Right.
Each country has its own rules and things. I mean, are we going to get to a European Union in Latin America? That's a long way off. And you see what's happening with that. Yeah.
There are some people and authors that are saying that there's going to be a bigger crash than the 2008 crash. What do you think about it? We don't know. A lot of money that's in the US, there to not be a crash coming. So, Michael only. I don't remember the other guy.
Crash where? Where's the crash?
I don't know, it crashed.
I mean, are you talking about a US crash? Or are you talking about a global crash?
Global crash.
I don't believe it. Look, I look at Europe. It hasn't even come up yet to crash. I mean, it still has to Greece and everything else. I mean, all of these things have to get sorted. Spain and Greece and these countries have to come back before they can crash again, right? Italy, yeah, you know, Germany's kind of holding all of this stuff together. You know, Asia, yes, I think that China, I think there's small pockets of overvalued. Yes, was China too hot with its growth rate, its real estate value? But we see that all the time in different pockets of the world. So yes, there'll be some, you know, change there. I don't believe that the U.S. market's overheated. Maybe the stock market a little bit because people are betting on what's going to happen in terms of growth. And by the way, there's a lot of money and it doesn't know where to go. Sometimes it stays buoyant because of that. But read the papers. The investment in Wall Street's having best year ever. It's back to 2007 revenues and profits. I don't believe that. It's certainly not going to happen here. You think Latin America's overvalued? It's going to pop? You think it's going to pop?
Yeah.
You think it's going to pop?
I don't.
No, I don't think it's overvalued.
Certainly.
No, I don't think it has any value. I don't. There's not enough of a market. So no, I don't believe that necessarily. I mean, I think there are places. I mean, we can pick them, but I don't agree with that.
But
I don't know, it's just me.
The spending on the deficit, on we break a war or natural disaster.
Yeah, I mean, look at the price of oil. Oil's low. I don't know. I don't. I don't.
I think it's basically about the amount of money that the US is printing. We printed more money from 2008 now than in whole history. So basically, I think about that, and they're saying that someday people is going to realize.
Yeah, because they're trying to keep inflation low. Yeah, but they used to say that about the deficit. I mean, don't you remember before Clinton came in and they said, Jesus God, how can a country have this kind of debt and it'll never get out? And the next thing you know, he turned to surplus. And a Democrat. I mean, I don't know. I don't know. Yes.
My name is Irna, and I think, Asian American. Also in your situation, I took a sabbatical for a while. I'm trying to go back in. I didn't have a degree from Wharton or Columbia, but I did go to MIT Sloan. So
better than me.
My question for you is, now that you're trying to go back into this world of business, what do you need? What are you looking for? Are you looking for invest? Are you looking for nice startup ideas?
Yeah, because it's different. I don't know. Well, first of all, you're a lot younger than I am, but and maybe you're looking to go back into an institutional world or a corporate world. I don't know, but I'm just looking to have fun and hopefully have an impact on something and not lose my money along the way. You know, maintain my lifestyle and make sure my kids can go to college. And I think that'll be better. No, really, I am. So I'm not looking for it in the same way. I'm looking more to meet interesting people and hear what they're doing and back them. I don't want to work for a big institution, raise funds and money again. Sorry, but.
So you are looking maybe for interesting startup.
Yeah. Yeah. Why do you have one? I think you do. I think you do. What do you do?
I'm a digital nomad right now.
You're a digital nomad.
Yes.
Wow.
I have lots of ideas around that.
Right? You talk to Marta?
No, I haven't.
Oh, you need to do that. Marta, you should talk to her. MIT Sloan, that's not joking around, Marta. And do you have an engineering background?
Chemistry with an MBA.
Okay.
She's in Argentina.
And why are you here?
Because I love tango.
Tango.
Yeah, no, not because of the weather or anything. The music and the dancers.
Who else? Yes.
Do you have any experience or knowledge in the VC environment in the West Coast? Okay, can you compare it with the East Coast?
Yes. When I was at Lehman in the early 90s, we had this fabulous idea of taking advantage of the West Coast VCs because we had done activity with the banks and stuff. And we thought, why can't we leverage these relationships and somehow come in at late stage growth? So in other words, leverage all the expertise and the diligence and the nurturing that these VCs are doing in Sand Hill Road, and come in and cherry pick them later in stage before they go public, which is what many investment banks try to do. So we try to pick pre-IPO kinds of things and late stage invest on the back of the who's who of Silicon Valley. So yes, we had some experience. Yes, it's a very closed network. And you really have to have some good relationships to sort of get in there and do that. And I wouldn't recommend it. I mean, it was an okay strategy, but it kind of backfired because we didn't really have the expertise or the technological knowledge to know about these companies. We hadn't incubated them. So we were basically trying to pilfer like pre-IPO stuff, which many people do now, by the way. You know, that's what they're all doing. They all jump in and try to invest in these things before they're public. So there's a business in doing that. The East Coast differs, first of all, because of their followers. So it's just like the world followed Wall Street and trying to figure out what it was doing. You know, New York followed the West Coast and trying to figure it out. And there was a, you know, tech alley, if you will, on Lower Park Avenue, and back in the meatpacking district, where some of the what I'll call the internet marketing companies, you know, the Yahoos and things like that started. So sort of that kind of stuff that wasn't as technologically sophisticated as the West Coast. So it's more the spin outs from the ad world and the creative world versus the spin outs from Stanford. I mean, if I could make a difference in the kind of character. So, and that's what I know about VC. And VC, as by the way, is a very cyclical business. I don't know if you looked at it in the United States, but you know, it's had decades of trough. I mean, where it's done very, very poorly and no one's invested. And then there's a few wins. I mean, all you hear about are the Googles and the whatever the world. You don't hear about the years and years of, you know, basic science investing and all of the stuff that's gone, you know, nowhere, or the Intels or the Incos or all these people divesting themselves of VC portfolios because they've not done much.
Do you know how many VCs are profitable, or
How many
VCs are profitable?
You mean they have good returns?
Are doing okay, yes.
I'd say the majority are. That the majority that exist today are, because if not, they're not there. It's like the only difference between the VC world and the private equity world and hedge funds is that you get a longer tail. So in the hedge fund world, you get about 3/4, and in the private equity world, you get about 3 years. So, you know, you stagnate for a while, you're gone. I mean, you're reading in the paper now about all the hedge funds closing. You know, all the tiger funds, for example, which are used to be stellar. The same is happening in private equity. They're all closing. There's many closing too. Yeah.
Well, let me ask you something. I mean,
Yeah.
related to the same question that you was asking. I mean, what's kind of like the difference between the success rate among VCs and among private equity? Because for example, VCs and startups, basically like 99% of startups fail. So what's kind of like the success rates you guys had in private equity in your experience?
Yeah. Well, it's not exactly 99% fail, maybe 95% fail in VC, but leaving out the mistakes of 2007 and 6, when everything got very hot in the private equity world, way overpaid for everything, leaving that mistake out. It is unusual for a private equity fund that's middle market or above to have a bankruptcy. My partner, who started investing in 1980, faced his first bankruptcy in 2010, after 30 years of investing. So it's not common. Why? Because you're buying late stage, you're buying companies with cash flow. It's your screw up if they're not doing well because you over leverage them. So you renegotiate. You can sustain it for a long time before it fizzles out. Or you go to the banks and you renegotiate things and you keep things sustainable. So maybe you don't get all your money, but you don't wipe out like a GC. So it's a different volatility. But the returns aren't as great either. I mean, right?
Yeah.
What do you think is the most important thing in a private equity fund or VC fund?
Growing.
If you were looking at it, I mean, if you had your sort of checklist and you were gonna sit down and evaluate my fund versus the guy next to me versus the guy next to him.
Yeah, that's great.
Marta, what do you think?
For me, I.
Most valuable thing in a VC firm, private equity firm, if you were doing a checklist and trying to figure out which is a good one and which isn't.
For me, it's money, return, and the impact.
For me, it's people. It's all about the people. And that goes back to their track record. I mean, of course, you're assessing investment return and whatever, but it's not the portfolio company's investment return. It's their investment return, right? It's not how good was that company. It's what did that person do to it? You know, their personal investment return. How good are they at assessing other people? It's all about people.
Is that
Yes,
for
impact
you?
is- yes.
Yeah, impact is people.
Yes.
Right. So, and Marta's whole business is looking around this table at you, and because you guys don't know anything. I mean, this is like barely even a business plan, and saying, you know, I'm looking at you, I'm believing what you say, and I think he can actually do it. He's had some success in prior life. The idea is good. I give it a shot. But that's what you're banking on.
That's okay. But in
So
general, in general, the people think that in venture capital or big venture capital or private equity is only the return instead of
No.
early stage or micro VC that are looking for people.
Yeah, but if you don't have anything, I mean, how do you assess return? Yeah, on the people. Absolutely on the people. Yeah.
More questions? I have one, maybe
Yeah.
one question. At a
How
personal
do I
level-
invest?
No, that would be after that private one. Even during your career, did you have opportunities to invest at a personal level in companies at either early stage?
Oh, I'm
or-
sorry, let's be clear. Okay, throughout my life, not my investment banking life where I was paid a bonus and a salary, which is investment banking. Most of my early compensation was completely tied up in what I did. So yes, I had a share of the carry, which stayed out a long time. Most of my compensation I put back in and invested in the fund, and they would match it. So they incentivize you to do that. They'd match it with leverage. So it was very attractive to do that. So yes, I'd say, 90% of what I made was tied up in what I did, but that's what you want. That's what you want from the guys managing your fund. That's what you want from the portfolio company that you're investing in. In fact, if they didn't have the money, the management, we'd lend it to them, all the better. Double down. When I first started on Wall Street, I had a boss that told me my favorite thing is when I see young people buying really expensive houses with enormous mortgages. And I'd say, why? He goes, because I have them. I have them capped. Exactly. To pay it off. Because I love that.
But we have the same boss.
So I like to do that too. No, you want them completely tied in and leveraged and everything else. And by the way, in the early days of private equity, I was telling Alejandro before this, that's how a lot of Wall Street people got compensated. They would create these private investment vehicles, they would put warrants and options, or maybe VC companies, little dribs and drabs and stuff they didn't know what to do with into an employee investment vehicle. And they turned out to be wildly profitable. The one that Lehman did in 1985, which was one of the very, very first, they had warrants, options, stuff, they put it in, they sold it to employees for $40,000 a unit. $40,000, we bought a unit of this thing. And in 1989, one $40,000 unit was worth $985,000.
Wow.
Yeah.
That was a good investment.
Yes.
Yeah.
It is. So a lot of the investment banks had private equity things because it was a way for employees to also get wealthy. So that was the feeder vehicle. If you wanted to turn on proprietary deal flow, give all of the investment banking partners a share in it, and then they're going to have that client that comes in that says, I don't know what to do about this division, and they're saying, let's go have lunch with the private equity group and see what they say. Yeah.
Well, Gwyneth, I appreciate your
I'm
time.
sorry I manipulated all your time.
No, it's fantastic. It was great listening to you, to your story. It's great that you are among us. It's fantastic you're an investor, an XP. I mean, it's
Yes,
great
Brandon.
I'm sure many companies that which XP invest would really like to have time with you,
Right.
like mentorship. So if that
Sure.
would be fantastic, and I'm sure you will find many opportunities in Argentina. Almost everyone in this room is betting on Argentina in the next years, one way or another. So we're in a bullish room.
Perfect.
And it's great to have you with us.
Thank you. Thank you very much. Thank you all.
Thank you.
Thank you.
Bueno, muchas gracias.